Distressed housing sales climb. Let's have a look. Hello everyone, Florian here and welcome to another episode of HeiseSays. Grab your stein of coffee. Let's look at this article from The Guardian that's discussing distressed housing sales. As well, we've all seen interest rates are getting higher and higher. Some are even approaching 7%. And for those of you playing at home, let's bring up the cash rate because I've got it programmed in here. You can see that significant increase. And people are betting that it'll keep going up. Now we have some buyers are hitting the 3% buffer for their home loans. You know, they were calculated on being able to meet repayments at the current rate when they took their loan plus 3%. Well, some are hitting that now, and distressed sales are actually climbing. Well, we'll have to see how bad it gets. But let's have a look at this, because the problem, honestly, is only going to face people who've probably bought in the last couple of years who FOMO'd in and really stretched themselves to the limit. And, well, honestly, you can't blame people for doing whatever they can to get into housing because it's our state religion here in Australia. So buyers who overpaid for properties in boom market conditions are now feeling the pinch, head of property investor groups say. So, distressed housing listings are on the rise as mortgage holders struggle under the weight of 7 consecutive interest rate hikes. The number of homeowners selling properties under distressed conditions has risen by about 15% since interest rates began to increase, SQM research found, from 5,753 in May to 6,658 in October. At the same time, the housing market is slowing. Now, it's true, the housing market is dropping. But we're seeing article after article every other week about, predicting yesterday, 20% house price crash prediction from the NAB. But we're coming off a peak, guys. It's still not going to be affordable. We may go back to 2019 prices. Remember 2019 when life was simple and housing was not affordable? At least not to the average Aussie. In the past month alone, distressed listings where the seller is forced into making a loss or accepting a lower price than they usually would, jumped by 5.7% nationally, with increases of 7.8% in New South Wales and 7.5% in Queensland. The chair of the Property Investors Council of Australia, Nicola McDougall, said many home buyers and investors overpaid for properties in boom market conditions last year, believing interest rates would stay low until 2024. And we're now feeling the pinch of spiking mortgages. The way the media reported from the Reserve Bank, pretty much saying interest rates will stay low until 2024, you can't blame them. I'm sure, I know many of the viewers of the channel, and myself included, didn't believe the Reserve Bank, probably because I've seen this chart so many bloody times and have very little confidence in their ability to predict the complexity of the economy to any degree of accuracy. And that's why I locked in. That means a lot of us are going to get a big surprise when we jump off sub 2% rates and are hitting 5 and 7%. Hopefully, you're prepared. So, it's not surprising that we're starting to see an increase in distressed sales because of the sharp increase in interest rates this year, she said. Mortgage repayments have increased so significantly in such a short space of time, which is starting to cause financial harm to many people, and especially those home buyers who perhaps borrowed too much. The 2022 Picker Investor Sentiment Survey found nearly 17% of investors had sold a property in the last 2 years to August, with a further 19% indicating that intentions to sell in the year ahead. The survey was conducted in August when the cash rate had been increased 4 times. It has now risen 7 times in as many months, McDougall said. Even in August, about 13% of investors said they were thinking of selling because rising interest rates were making it harder or impossible to afford. And I believe someone mentioned in the comments of a recent video how he's got a mate who's paying for his mortgages, on credit card. Okay, just think about that. This is the people taking out loans to make their afterpay payments. He knows someone who's borrowing on their credit cards to make their mortgage repayments. Now, I remember I had a boss who bought a house in Brisbane where he paid for the whole deposit just on a credit card. Just boom, did it, him and his wife, when they were first getting started. That's a bit different because they could get the money and pay it off. And housing was not as insane as it is now, to needing it to make payments on your investments. Can't sell the properties. So they're going to have to take a loss. On Tuesday, the Reserve Bank raised interest rates by another 25 points to the official cash rate of 2.85. The latest interest rate rise will add more than $114 a month to repayments for a typical $750,000 mortgage. Now, how many of you have a mortgage that's less than $750,000? Because that's nuts. That's getting right up there, isn't it? The president of the Real Estate Institute of Australia, Hayden Groves, said it was anticipating mortgage stress would begin to escalate in 2023, particularly as there had been basically zero distressed sales during COVID. Yeah, pretty much. Now, we've got to understand mortgage stress or housing stress, the definition from the ABS definition. Let me just bring that up. Are we looking at that? Nope. Last thing we looked at was La Nina in my videos here. So let me just bring up that definition for everyone, because it's important to realize there's a few differences in how people measure this. And this one, well, housing stress at least, it's described as lower income households that spend more than 30% of their gross income on housing costs. And this is lower income households. It's not everyone. There are going to be some people who are on good coin who can afford to pay more than 30%. They won't even notice it. There's going to be other people who are right at the edge, but are going to have to make some drastic changes to their day-to-day life. They're going to have to, well, cut the luxuries, frankly, or do it tough for a while, which isn't the end of the world. You come out stronger for it. Banks were holding off any action on loan holders, he said. Some of that is now slowly starting to lift, and the major challenge is the rapid rise in interest rates. People who might have been on fixed loan terms at 2% will suddenly find themselves with a threefold rise, and in markets like Sydney, where housing affordability is most constrained, up to 46% of people's incomes are going to mortgages. Grove said it was likely first home buyers who bought during a COVID stimulus period and investors struggling to hold two mortgages were the hardest hit, particularly in rental markets like Sydney and Melbourne with low net returns. There's not a lot of wiggle room if interest rate rises continue, he said. It's a shock to the system. The research director of ratecity.com.au, Sally Tyndall, said each month the cash rate was increased, the amount banks were willing to lend borrowers shrank, making it particularly difficult for first home buyers to enter the market. This has the property market rattled, with both buyers and sellers exiting in droves, she said. The hordes of cashed-up buyers are gone. But also you have to remember we're going to have increased demand, adding support to the sector. 500,000, a surge of 500,000 temporary visa holders coming to Australia. You've got the permanent migrants increasing to over 200,000. Okay, all of these add support to property. So, but there are going to be some people that kind of did the stupid, followed the property bros, and you know the story, guys. Equity mate. The value of new approved home loans dropped 8.2% in a month. ABS data released on Wednesday found, falling to the lowest rate since November 2020. Research director at CoreLogic, Tim Lawless, said it was unlikely the worst of the decline was over as borrowers faced the double whammy of further interest rate hikes and rising inflation. There is a genuine risk we could see the rate of decline re-accelerate as interest rates rise further and households' balance sheets become more thinly stretched, Lawless said. CoreLogic's latest home value index, released on Tuesday, found every capital city and regional area, excluding South Australia, recorded a drop in housing values last month, the sixth consecutive months of decline. Brisbane experienced the sharpest fall of 2%, followed by regional New South Wales at 1.7%, Victoria at 1.4%, and national values fell by 1.2%. What I want to show... Sorry about that, I shouldn't be moving that when I'm recording, but it's a luxury operation here. Let's look at asking prices in Brisbane. Let me just reload this page so it comes up. Okay, now, oh no, Brisbane fell 2%. Look at that increase. Okay? Look at that increase, guys. So anyone who bought here, it's all bullshit. Okay, so whoop-de-doo if it goes down in Brisbane. You can't complain. Okay, if you bought at the peak, well, you're going to have some frustrating emotions. But for the rest of us, come on, guys. You're up over 100% on a property you've done nothing to. That doesn't mean you're a property genius, okay? It doesn't mean you're a property genius. You should not start selling a course online. It's called luck. So, despite the dip, house values remain well above pre-COVID levels. Nationally, values have dropped 6.5% compared with a 25.5% rise through the upswing. Sydney values are down 10.2%, however, compared to a 27% rise. There you go. Melbourne down 6.4%, but 17.3% up. So you can see we're not going to go that far back in time. This isn't the mammoth crash that people are hoping for. It's Australia, guys. They'll chuck everything they can at the property sector. It's a huge part of our economy. What's more than that, honestly, it's part of our culture. It's part of our culture. Affluent inner city suburbs have been amongst the worst hit. Sydney buyer's agent Paul McGullen said he'd received reports of declines in returns of up to 25% in both Surrey Hills and Northern Beaches. I'm hearing from sellers and agents that they're selling off investment properties in some areas where the return is useless, he said. Most sellers are lots of mum and dad investors that make up the proportion of the average. People that have holiday rentals in coastal areas are also selling up. At a time when the spring selling season traditionally peaks, national listings are instead in a decline, sitting 25.2% lower than last year and almost 19% below the previous 5-year average, according to CoreLogic. At the same time, just 59.8% of auctions held across the city in the weeks ending 30th October were successful. Oh boy, compared to 76.8% this time last year. So auction clearance rates are not looking as good. So let's have a talk about this. I mean, this is not shocking. This is not surprising. We're just coming off a surge. We're coming off a property surge. Now, is this the hopes and dreams of all the people sitting eagerly waiting on the sidelines? I don't think so. Sure, we're going to see housing drop a little bit, but is it going to be enough to change the culture? That's the question. Is the argument that as good as housing, is that going to disappear from Australia? I can't see it. I mean, look at crypto. It's just gone down the toilet now. We'll have to see if it breaks below 15,000. Then it's what? Anyway, when's the next support level? Look at the stock market. It's not doing as good as it was. A lot of shares are off their peak. But I mean, there you go, guys. Something to keep an eye on. Let me know your thoughts and opinions on this one. Thanks for watching. Check out my other channel, HeiseBim and HeiseSays International, for other topics I discuss. And I will see you all in the next episode of HeiseSays. Take care, guys. Have a great day. And keep going. It'll be good. It'll be okay. I better go check on my excavator. He's gotten all quiet. Let's see if he's finished digging up my renovations.